Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at CoreWeave.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And right before we get into the main discussion, there's a really useful chart tool for investors and traders we wanted to quickly mention. The link is right below in the description.
Yeah, it's called VIP Algos. It's essentially this TradingView indicator suite that gives you visual buy and sell chart alerts, which is super handy.
Right. It has trend direction tools, support and resistance zones, and even areas for take profit and stop loss planning. You can use it across a bunch of markets like stocks, Forex, crypto, indices, pretty much whatever you're looking at.
But we do need to be clear. VIP Algos is an educational chart analysis tool only. It is absolutely not financial advice.
Exactly. It doesn't place trades for you and, doesn't guarantee any profits.
Because trading involves risk. You always have to manage your risk and do your own research. And just full disclosure, it is an affiliate link, so the show may earn a commission if you use it at no extra cost to you.
Okay, so let's dive into this massive market story, because CoreWeave has been on an absolute tear lately.
Yeah, it's wild.
It is. I mean, the stock is up nearly 20% just this past week alone, trading right around $117.
Which is just a violent move upward for a compler of this size. But, we have to be really honest with everyone right off the bat here.
Right. A lot of this immediate price action, it's not actually about the underlying fundamentals.
Exactly. It's pure market mechanics. CoreWeave is officially getting added to the NASDAQ 100, and that inclusion hits on June 22, 2026.
And if you've never watched an index inclusion play out, it is, it's basically robotic buying.
Yeah, because every passive ETF and mutual fund tracking the NASDAQ 100 is legally forced to buy the stock. They just have to match the index weighting.
They don't care about the price. They don't care if it's overvalued. They literally just hit the buy button.
So what you're seeing right now is active traders and hedge funds front-running that event. They're buying today because they know trillions of dollars in passive funds are going to be forced to buy it from them next week.
It's a massive liquidity event. But if you're actually trying to build long-term wealth, you really have to look past all that mechanical dust settling.
Yeah.
You have to know what you're actually holding.
All right, let's move into the wealth building context.
Okay, so when people hear cloud computing, they usually default to the legacy players, right?
Like Amazon Web Services or Microsoft Azure.
Exactly. The generalists.
Yeah.
The ones hosting your company's email and storing photos. But CoreWeave is categorized as a platinum neocloud, and they are Nvidia's chosen exemplar cloud specifically for artificial intelligence inference.
Okay, let's translate that for everyone. If traditional clouds are like these massive commercial airlines that carry a little bit of everything, passengers, cargo, whatever, a neocloud is like a fleet of highly specialized fighter jets.
That is a great way to look at it.
It's custom-built architecture doing exactly one thing: processing massive AI workloads. They are the hyper-dense, liquid-cooled physical hardware that actually makes large language models function.
Right, so you can kind of view them as the exclusive coal road or the utility company for the AI infrastructure age.
But that's the big question, isn't it? As an investor, is this just a hyper-growth, speculative play riding a hype cycle, or is it a foundational cornerstone for a portfolio?
Well, it fits a really unique growth infrastructure profile. I mean, think about software. An AI app can be disrupted overnight if someone writes better code.
Yeah, software moats are super fragile right now.
But physical infrastructure, securing land, building liquid cooling facilities, getting thousands of Nvidia chips that takes years, and billions of dollars.
So it's for investors who want to look past the short-term software hype and bet on the actual physical hardware lock-ins.
Now let's look at the fundamentals.
Because the growth trajectory here almost looks like a typo.
It really does. They are the fastest cloud in history to hit $5 billion. For full year 2025, they did $5.131 billion. That's a 168% year-over-year growth rate.
And they aren't slowing down. First quarter of 2026, they hit $2.078 billion in one quarter.
Up 112% year-over-year. But here's the absolute jaw-dropper. The crown jewel of this whole thesis is their backlog.
Oh, yeah. The backlog numbers are insane.
As of March 34, 2026, they have a $99.4 billion revenue backlog.
Just let that sink in for a second. $99.4 billion in contracted, non-cancelable revenue.
And it grew roughly 50% in just 3 months. They signed over $40 billion in new commitments in Q1 alone.
And we're not talking about small fry here.
No, we're talking about Meta signing for $21 billion, OpenAI committing $22.4 billion, Jane Street dropping $6 billion.
Okay, but I have to push back a little here. If you're Microsoft or Meta and you literally print cash, why are you waiting in line to sign $20 billion contracts with CoreWeave? Why not just build the exact same data centers yourself?
It comes down to a massive technical edge and a massive physical barrier. On the tech side, CoreWeave just trained the DeepSeek V3-671B benchmark in 2.02 minutes.
Wait, 2 minutes. For a 671 billion parameter model.
Exactly. Using 8,192 Nvidia GPUs.
Mhm.
And they did it on their actual production infrastructure, not in some controlled lab.
Wow, so their full-stack software and networking are just legitimately faster?
Time is money in AI.
Yeah.
But the physical barrier is even bigger. It's the power grid. They hold 3.5 gigawatts of contracted power right now.
3.5 gigawatts. That is a massive barrier to entry.
And they're aiming for 8 gigawatts by 2030. They basically bought up all the water rights in the desert before the gold rush really started.
Right, so if Meta wants to run their models, they have to buy the water from CoreWeave. But let's pivot to the bearish side of these financials, because the balance sheet is, frankly, terrifying.
It is definitely heavily leveraged.
Heavily leveraged is putting it mildly. I'm looking at a $740 million net loss in Q1 and a free cash flow burn of $4.71 billion every single quarter.
Yeah, that's a lot of cash going out the door.
Plus a mountain of debt, $7.5 billion in current debt and $17.31 billion in non-current. How does a company survive that kind of cash incineration?
Well, you have to look at it as an investment phase. They are experiencing massive margin compression because they are literally building the physical data centers right now.
Like building a skyscraper. You bleed money until the tenants move in.
Exactly. And the cost of their debt is actually improving. Their delayed draw term loan carry cost just dropped from 15% down to 5.9%.
Okay, dropping from 15 to under 6% on billions of dollars is a massive relief valve.
And they just raised another $1.25 billion and 2 billion euros in new notes. But the real backstop, Nvidia.
Right, Nvidia's involvement changes the math completely.
They took an 11% equity stake, poured a $2 billion investment into them in Q1, and they have an $8.5 billion non-recourse facility backing them.
And that non-recourse part is huge. It means if a data center fails, lenders can only take the servers, not CoreWeave's corporate assets. It fences off the risk.
And Nvidia simply cannot afford to let CoreWeave fail. They are too critical to Nvidia's own ecosystem.
That brings us to the catalyst timeline.
So we obviously have the near-term trigger, which is that June 22 NASDAQ 100 inclusion we talked about.
The mechanical buying. But looking past that, we have to talk about the speculation around the upcoming August 13 earnings report.
Well, the rumor mill is in overdrive right now.
It really is. Jim Cramer recently cited a third-party research note suggesting that the backlog might actually be materially higher than that $99.4 billion figure.
The rumor is that it could exceed $125 billion.
Now, we have to warn you, this is highly speculative. You should not base a strategy on a third-party rumor. But if that number is confirmed in August,
the re-rating potential for the stock is massive. Plus, management expects adjusted operating margins to hit low double digits by Q3 or Q4 of 2026.
That margin inflection point. When the skyscraper is finished and the rent checks finally start clearing.
Now let's pivot to the chart.
Because the price structure right now is just momentum on steroids.
It is. Closing around $117, the stock is up over 65% year to date.
And up nearly 200% since its March 2025 IPO.
But as you pointed out earlier, we have to be risk aware.
Right. At 8.81 times trailing sales, the market is pricing in flawless execution, any delay in construction, and that multiple gets crushed.
And if you look at the chart, the 200-day moving average is lingering way down in the $100 to $105 zone.
Which a lot of analysts view as the preferred risk-reward pullback zone if you miss this recent explosion.
Because there is a very real sell the news reversal risk here.
Exactly. Once that mechanical passive fund buying completes on June 22, the robotic support disappears. So what does market sentiment look like?
In a word, euphoria.
Yeah, Wall Street loves this right now.
5 out of 5 top stories are overwhelmingly positive. BNP Paribas sees a target of $192, and one analyst is actually calling for $266.78.
That's a massive upside target, but I have a huge red flag question for you.
Okay, let's hear it.
If everything is so great, why are the founders cashing out? They've sold over $2.3 billion worth of stock since the IPO lockup expired. Are insiders running for the exits?
Look, $2.3 billion is a scary number. But context matters. The stock is up 200%. Any financial advisor would tell founders to diversify their personal wealth once a lockup ends.
Fair enough. You don't want your entire net worth tied to one tech stock.
And they still have massive skin in the game. But more importantly, while the founders sold some, Nvidia actively poured a $2 billion equity investment in during Q1.
Okay, yeah. If the biggest, smartest player in AI hardware is buying in at these levels, that definitely balances out the insider selling fear.
Now let's talk about the risks.
Because the execution required here is bordering on superhuman. Management is guiding for $31 to $35 billion in CapEx for 2026.
Deploying that much capital in a single year is the primary bear case.
You have to secure real estate, build liquid cooling, fight for permits, rack tens of thousands of GPUs. It's a logistical nightmare. And like we said, net interest expense doubled year over year to $536 million in Q1. If they stumble, the capital cliff is real.
The other big risk is the hyperscaler threat. Yes, CoreWeave is diversifying. Microsoft used to be 62% of revenue in 2024, and now they have 10 clients over $1 billion.
But the existential threat is that those exact same clients are furiously building their own data centers.
Right. Will neocloud demand just dry up once big tech finally catches up on their own physical infrastructure?
Are they just paying the CoreWeave toll today out of desperation? It's a huge question. But, the market seems to be pricing that in.
It is. CoreWeave trades at about 7.5 times forward revenue. If you look at a peer like Nebius, they trade at 17.34 times forward revenue.
That is a massive discount, which shows the market is acutely aware of these execution risks. So with everything on the table, what's the final verdict?
Synthesizing it all, CoreWeave gets a bullish score of 8 out of 10. The consensus is that this is a multi-year hold.
With that August 2026 earnings report being a massive inflection point.
Exactly. The upside is driven by that unparalleled $99.4 billion visibility, the Nvidia backing, and that insurmountable power moat. But the downside is extreme capital intensity.
Right. And as a reminder for our risk-conscious listeners, this is not financial advice. Patience for a pullback toward that $100 to $105 moving average might be safer.
While more aggressive momentum investors are clearly banking on that $125 billion backlog rumor.
So you have to manage your own risk. And actually, just to leave you with a final thought to mull over today, if one specialized company can lock in nearly $100 billion in revenue just by securing electricity early, what happens to the broader economy when the legacy power grid just can't handle our digital ambitions? It's something to seriously think about. And if you want a cleaner way to read trading charts and find those key moving averages and support zones we talked about, check out VIP Algos through the link below in the description.
It's a great TradingView indicator suite for visual buy and sell alerts, trend direction, and TPSL zones.
Just remember, it is an educational tool only. It is not financial advice. It does not place trades, and there are absolutely no guaranteed results. Trading involves risk, and again, it is an affiliate link, so we may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.